Hi, today we're going to dive into another facet of home mortgages and how to get ready to apply and ensure your loan is approved. Specifically, we're going to talk about how lenders use your debt to income ratio to determine your eligibility for a loan. And trust me, it impacts more than just your ability to get approved. Before I dive into the math, pro tip, you may want to increase the playback speed because I'm going to get into the details of the calculation process, although normal speed is good. And if you need to pause or rewind, I'll be right here when you get back. Now let me quickly define what exactly debt to income ratio is and explain a couple of terms I will use during this video. Sometimes debt to income ratio is referred to as DTI. In fact, I may slip up a few times and say DTI in this video. It's a simple equation that divides your gross monthly debt payments by your gross monthly income. Gross income is the amount on your pay stub and W-2 before the taxes are withheld. Basically, this is a way for lenders to see if you're drowning in debt or if you've got your financial ducks in a row. Did you know that there are actually two debt to income ratios the mortgage lender looks at when analyzing your application? There's a front end ratio and a back ratio, sometimes referred to as the top ratio and the bottom ratio. Today, I will refer to them as the front and the back. Now stick around until after we make sure the math is mathing, and I will share some additional tips and pitfalls about your debt to income ratio. Now, let's get down to business. Imagine a two-income household with a total annual income of $120,000. We'll calculate the DTI using the proposed new house payment of $2,800, two car payments of $325 each, credit card payments totaling $150, and a student loan payment of $75. In this example, let's first figure out the monthly income. If the annual income is $120,000, we'll divide that by 12 months. This equals $10,000 in gross monthly income. Now that we have the monthly gross, let's calculate the front ratio. In our example, the proposed new house payment is $2,800. So divide $2,800 by the gross monthly, and boom, our front ratio is 0.28. Move the decimal 2 places to the right, convert it to a percentage, and we have 28% for the front DTI ratio. That wasn't so bad, was it? Now, let's add up the monthly payments of all the debts, including the new proposed house payment. In our example, it's $2,800, $325 twice, $150, and $75 divided by $10,000 of monthly income. The answer is 0.3675. We've moved the decimal point over to the right 2 spaces, and your debt to income ratio is 36.75%. So our front end ratio is 28%, and the back end ratio is 36.75%. Your lender would say your ratios are 28 over 36.75. Now let's talk about why this ratio is so important. You see, lenders want to make sure that you can afford to pay back that shiny new mortgage they're about to give you. By looking at your debt to income ratio, they can evaluate your ability to handle additional debt responsibility. It's their way of saying, hey, can you actually handle this mortgage without turning your life into a never-ending episode of Survivor Debt Island? But here's the catch. The higher your debt to income ratio, the riskier you might seem to lenders. That means they might offer you a higher interest rate or even deny your mortgage application altogether. In our example of 28 over 36.75%, those are virtually the ideal debt to income ratios in the eyes of a mortgage lender. Their analysis will tell you that your debt load should be manageable and leave you some cash left over every month for your savings account. Okay, Jason, what if my debt to income ratios are higher than this fantasy example of yours because my income is slightly lower or my monthly debts are slightly higher? Does that mean I'm out of luck and I can't buy a home? Luckily, the majority of residential mortgage lenders utilize 2 automated underwriting systems to approve your application, at least preliminarily. If you'd like a video about those 2 systems, let me know in the comments. Anyway, back to the buyer with the higher debt to income ratios. If the automated underwriting system approves your application, even though you have higher than ideal debt to income ratios, then a mortgage lender may still give you a mortgage. How high can your debt to income ratios be? I'm glad you asked. With the right credit scores, job history, and down payment, there are mortgage programs that actually allow debt-to-income ratio to be as high as 46 over 55%. Since there are endless types of borrowers, the best advice is to find an experienced mortgage loan officer that can walk you through the nuts and bolts of how much home price you are qualified to buy. Bottom line, your debt-to-income ratio is a big deal when it comes to getting that dream home. Make sure you keep your debts in check and your financial house in order. Your future self will thank you when you're sitting on that porch, sipping lemonade and basking in the glory of a mortgage well managed. Did I miss anything? If I did, let me know in the comments. Don't forget to like, share, and subscribe or follow for more content like this. And check the description for links of some of my favorite home gadgets. That's it for this video. I'll see you in the next one.